Okay, so today we're going to break down a single $4 million trade that tells this amazing story about how the market thinks, or maybe how it doesn't think. It's a huge bet against the crowd, and it's basically a masterclass in seeing a massive opportunity where everybody else just sees panic. The company is Coupang, and this is the story of the whale who decided to swim against a very, very strong tide.
To really get this bet, you got to understand the vibe around Coupang at the time. And let me tell you, the mood was, well, it was bad. The headlines were all negative, investors were dumping the stock, and the company was right in the middle of a huge crisis.
And wow, this number, it really says it all. In just 1 month, the stock had tanked more than 16%. Now, for a company this big, that's billions of dollars in value just poof, gone. The momentum was pointing straight down and fast. So that's what makes this so wild, right? It brings us to the central mystery here. The stock is in a total freefall, the news is terrible, so why on earth would somebody, a whale as they call them, step in and make a multi-million-dollar bet that the bleeding was about to stop? I mean, it goes against every instinct.
And that's exactly what we're here to do. We're going to follow the money, follow that digital paper trail, and deconstruct the cold, hard logic behind what, on the surface, looks like a totally crazy gamble, but you'll see it might just be an incredibly smart, calculated move.
All right, first things first, let's look at the trade itself. What did this $4 million bet actually look like? Let's dive into the specifics.
Okay, so let's get into the nitty-gritty. A trader sold 2,000 of these things called put option contracts. Now, in simple terms, here's what happened. They got paid $200,000 cash right up front. And in exchange for that cash, they made a promise, a big one. They said, hey, I promise to buy 200,000 shares of Coupang for $20 a share, but only if the stock drops that low by June of 2026.
And this is the number that makes you lean in, right? Because by promising to buy 200,000 shares at $20, this trader is on the hook for a potential $4 million purchase. Yeah, this isn't some small-time bet. This is what we call smart money making a very loud statement.
So we know what the trade was. Now let's talk about how a trade like this actually works. Because once you understand the mechanics, you start to see the hidden genius in how it was all put together.
You know, the easiest way to think about selling a put option is like this. You're basically selling insurance on a stock. You get paid a fee, a premium, today. And in exchange, you only have to pay out, in this case, by buying the stock, if its price falls below a certain level. So, at the end of the day, you're getting paid to put in a lowball offer on a stock you might have wanted to buy anyway. It's a pretty sweet deal.
Okay, let's do the math here, and it's actually pretty simple. The stock was trading around $23.50. The whale agreed to buy it at $20. But here's the kicker. Remember that premium they collected? It works out to $1 per share. So their actual break-even price isn't $20, it's $19. The stock has to crater all the way down to $19 before they even start to lose a single penny on this trade.
And check this out. This chart just lays it all out perfectly. They built in this incredible buffer. From where the stock was trading, it has to fall more than 19% just to get to their break-even point. And notice how that $19 break-even price lines up almost exactly with the stock's 52-week low. It's like this trader drew a line in the sand at a level where the stock has historically been really strong.
Okay, so we've got the what, we've got the how. But the real question, the big one, is why? This wasn't just a random shot in the dark. It was a calculated move, and it looks like it was built on a really strong 4-part thesis.
See, it looks like this whole thing is built on 4 key ideas, and they all just click together perfectly. First, the trader thinks the stock is an absolute bargain at $20. That's the fortress valuation. Because they think it's cheap, they'd actually be happy to buy the shares there. That's the strategic accumulation. Now, the market panic, that panic makes the price of options go through the roof, which lets our traders sell them for a huge premium. That's how you short the fear to create a high-yield synthetic dividend. Let's see how it all works.
So pillar number 1, valuation. Price to sales sounds complicated, but it's not. It's just asking, how much are you paying for $1 of a company's sales? At that $20 strike price, you'd be paying just $1 for every dollar of Coupang's sales. Meanwhile, the market pays over $3 for every one of Amazon's. This tells you that $20 could be a serious valuation floor, a price so cheap it makes perfect sense to start buying shares, which of course is that 4th pillar.
Now for the other 2 pillars. What's really cool is this. Coupang doesn't actually pay a dividend, right? But with this trade, our whale basically created their own. That cash they collected up front generates an annualized yield of over 11%. So why is it so high? Well, that's pillar number 2, shorting fear.
All that panic in the market makes options crazy expensive. By selling those options, this trader is literally converting market fear directly into cold, hard cash. They're being paid a fortune to wait, with a yield that just crushes what you could get from traditional investment. But hang on. For a deal this good to even exist, there has to be a catch, right? There has to be a reason everyone is freaking out. So let's be fair and look at the other side of the coin. Why was everybody selling?
And it all comes down to this one thing: a huge data breach. A former employee got access to the data of 33 million user accounts. The real fear, though, was about the punishment. South Korea has some really strict privacy laws, and the headlines were screaming about a potential billion-dollar fine. This was the source of all that panic.
But this, right here, is where the whole thesis gets its edge. Look at this disconnect. The market reacted to the news by vaporizing $8 billion of Coupang's market cap. The absolute, worst-case, legally possible fine, just over $1 billion. The market punished the company by nearly 7 times the maximum possible damage. That's not logic, that's just pure emotion.
So you have to ask, okay, worst-case scenario, can Coupang actually handle a fine that big? And the answer is, oh, absolutely. The company brings in $2.4 billion in cash from its operations every single year. They could pay that max fine with just 6 months of cash flow. This is a headache for sure, but it is not a catastrophe that kills the company. Not even close.
All right, so let's tie this all together. We've seen the trade, the thesis, the panic. So what's the final verdict on this $4 million bet?
You know, this quote just perfectly sums up the entire play. The market's mood is total panic, driven by scary headlines. The math is the company's rock-solid cash flow and its cheap valuation. This trader is making a huge bet that, over time, the numbers are going to matter a whole lot more than the noise.
So let's just run through it one last time. The traders saw a massive overreaction to some bad news. They used the perfect tool, the short put option, to turn that market fear directly into a high-yield paycheck. They built in a massive 19% safety net, all the way down to a level where the stock is fundamentally cheap. And the sheer size of the trade tells you this isn't a guess. It's a high-conviction bet from someone who's done the homework.
And really, that's what this whole story leaves us with. It forces us all to ask a pretty fundamental question. So next time you see the market panicking, and the headlines are all doom and gloom, and everyone is running for the exits, you gotta ask yourself, is that a signal to run with them, or is that the exact moment you should stop, take a breath, and start doing the math?